All right. So now it's really all about controlling risk. I mean, risk is very important. Now, I will try not to be able to make too many numbers here because I don't want to freak many of you out. But I want I want you to be able to walk out of here understanding why we talk about risk first. In fact, if you go into the global market, you're going to find that these savvy traders, these experts out there, before they even buy anything, the first thing they assess is risk, not reward. They always check, what do I lose? And they always want to do that because their capital is very important to them. So you want to keep your losses at a minimum. Don't obviously do not make them at a maximum. Second, capital or the funds that we have to trade is our lifeblood here. It's like the oxygen that you put into a tank on a diver who goes underneath water. If you don't have that oxygen, you're done for. You cannot exist in that underwater environment. So our funds are what keep us alive in this game and allow us to be able to make more profit. The minute you sink that value too low, we're not going to be able to make things happen here. And that's why you have to be able to watch out of this quite carefully. Now I'll lay this out for you just so you can get a sense of it. When you take a trading loss, let's say you take, for every transaction you make, let's say you only allot a 1% loss caliber on that transaction. So for example, if I lose in that stock and I only say for every loss I take maximum of 1%, that means I will have to make 100 transactions and lose 100 times before my money is completely extinguished. If I use 2% as my threshold, so for example, I take a trade and I will only stop it out if I lose 2%. Okay? If the 2% becomes a loss, that means in 50 trades and I lose 50 times, then I get washed out. Assuming I lose 4%, this threshold here, and that means it'll take you 25 trades before you get washed out. And clearly, if I use 10% as my stop loss threshold, that means if I lose 10% in 10 trades, I'm done. Right? So it's very important you try to narrow your losses out and try to choose something that may be within the first 3 numbers here and not the last 2 numbers here, because these might be a bit too big, right? Also, when you lose, I really want to point this out. It's hard to make that money that you lost back. And so that's why you want to put more effort into it of preventing that from happening. Imagine, if you lose 10% of your portfolio, that means you have to make 11.1% just to break even. If you lose 25% of your portfolio, you will now have to make 33.3% just to break even. And imagine if you lose 50% of your money, that means you lost half your capital. You have to make double your money in order for you to just break even. And imagine if you lose 80%, you have to make 400% just to break even. So please, I mean, you really have to put a safety net into everything here. Mind your risk. We put protective stocks for a reason, to control that loss, because we don't want the emotion to get in the way. Many times, it is that causes the biggest losses, though not wanting to accept a small loss that eventually becomes a much bigger loss. And that's why, when you're walking, please don't walk over an open manhole, because that's what you do when you don't have a protective stop. If you don't have a cut loss point, you need to secure that. If not, you just fall right under and you get engulfed, whatever happens there. Now, diversification is important, yes. But to a trader who knows what he's doing, diversification is all about finding the right quality of stock with the right assessment into it, the technical assessments into it. Now, the reason I want to do that is because, for example, if you're looking for a potential buy, and here you are, you're going to be buying, let's say, you're going to be buying Ayala Land, SM Prime, Robinson's Land, and Mega World. So here you're buying so many stocks all in the property sector. If something were to happen into the property industry, every one of your 4 stocks will go down, right? So you might be saying that I'm spread and I have 4 stocks, but the problem, the industry inside might create a much weightier risk. That's like you buying 1 stock all in the same property sector. So try to vary. Maybe you want to buy a property, then a telco, then something else. Preferably what you're buying should be in an industry that's doing well. right? So don't just buy it because it's cheap. There has to be some other resolute reason why that thing should be able to go up. Second, try to run a well-balanced portfolio, okay? And when I say that, remember, you've got big caps, you've got mid caps, and you've got small caps. What is a big cap? Big caps are pretty much all your blue chips. Big companies, proven, these guys are doing well. They trade quite a lot in terms of volume. However, some of them may not move very, very actively into percentage-wise, but some can. Then you've got the smaller caps, and the smaller caps are tiny issues that hardly trade any shares. They could go lightning up and down in a bat of an eye. Sometimes you can see 10, 50% in a day. And I know that might allure many of you and might draw you in, but like a moth to a candle of a flame, you could get burned. So if you want to be able to trade smaller caps, especially for those who are not that seasoned yet, I would recommend that smaller caps should be a contained or smaller part of your overall portfolio, maybe 20% or lower. Okay, distribute the rest into bigger caps, into mid caps, and that way you can try to be able to contain any movements you have inside. Also, do not over diversify. I did say earlier, try to have maybe a maximum of 3 to 5 stocks only. Ask yourself this question: if you are a trader and you buy 20 stocks, why do you buy 20? Because you want to be diversified? I think the reason people buy 20 stocks is because they feel just they don't know what to pick. And so what do they need to help to hit my target of making money? They get a bazooka and they try to hit it, so the explosion of a bazooka brings all the pieces down and they can hit everything with it. But that's a very inefficient way to knock down a target. You should be like a sniper, a guy who takes in, very efficient in his bullets, looking at one single target, picking off 3 or 4 times. It's more efficient. You can make more money that way, rather than throw a hefty amount of money in a blanket of stocks of which that you don't even know what it is that you're going. And I'm sure that's the reason why you're doing that. If you're going to be a trader and you're going to be buying 20 stocks, may I just give you a piece of advice? Why don't you just buy an index fund instead? I think you'll end up probably working out much better, and you'll put less factor into it. So please, if you're going to go into a bazooka type of trade, I think just buy your index stock, and that might just be better for you. For those people who are a bit more seasoned, 3 to 5 stocks, that should be able to fare out well. Now let's talk about adding up to a position. If you want to be able to, let's say, for example, you see a breakout, and in a breakout condition, you're not really very sure about yourself because there's certain things, there are imperfections, let's say, in the technicals, or you feel something iffy about the company you're about to buy. And because of that, you want to take a small step first because you don't feel inclined to put everything all in just in one go. So if you actually buy a small portion of that particular transaction, remember this. I want you to be able to make sure that you're only adding up to a stock position that's making money for you, right? So if you buy your first position and you want to add up because it's making money, fine. But you shouldn't be adding up to a position where you bought a stock and it falls way below your price, and now you're losing money. And your call is, let me buy lower so I can average my price, average down. Please don't do that. I mean, if you're an investor, perhaps those are the techniques you may seek. You're a trader. You should know better. You are a creature that knows and understands a sense of timing. And obviously, you bought something at the wrong price, and as prices are now falling and you're losing, don't add to that losing position because it puts you in a position of disadvantage. Imagine your mindset buying a stock that you're making money in. I'm sure it's all about confidence. I want you to imagine now the opposite. Here you just bought a stock. It fell down. You're losing money. And now you're going to add more money into that. You already don't believe yourself, and you probably thought something wrong. And you're just trying to be able to put a band-aid on something which could actually hurt you more. Because what happens if that stock falls down again? Will you buy more one more time? Will you buy more 3 or 4 more times? Or will you just keep continuing to buy more until you have nothing left to buy with? So that's not the situation we want to put up here. Use what we call the upright pyramid method in adding up to a position. If you look at the image I have over here, assume this trend in price, you see this zigzag movement up in price is your stock price. If you're coming into a potential breakout condition, remember this, your first purchase should be the biggest. Okay, this is in your first or level 1 zone. Finally, when your stock explodes and starts to run into your next capacity, if you want to add, fine, but your second purchase should be smaller than the first. Okay, and after that, maybe a new area pattern will be built, and maybe another breakout will take place for it to go to stage 3. And into this stage 3, yes, you can add again, but this time I want you to put in a smaller position than what you put in the second stage, right? And you cannot be putting the biggest amount into that third stage, which is the biggest and most common mistake traders do. And the reason is very simple. As the stock price climbs up, the more confident they are, the more money they've made, and the more emotional they become and greedy that they want to make even more. And it's because of that that 8 out of 10 traders normally put more money near the high of a stock than near the entry level of a stock. And that's where people lose up. So please understand what you should do and do it right.